Good afternoon. It's our 3 p.m. again on Tuesday, so it's a shorter time. On Saturday, 3 p.m., I always do it about an hour. Folks always say that, oh, Ying, if you want your channels to be more, to have more subscribers, you need to keep it shorter. So I always struggle with that idea because it is hard to give you a complete list with just few seconds. TikTok is not working for tax professionals, so I don't think I can do it in very short time. But I'll try to focus on everything that can be done right now to save your 2024 taxes. So, we're in 2025. So some of the stuff can no longer do. And you can't go out now spending money and say, oh, I saved that for 2024. No, only certain things can. So I'm making a comprehensive list for you. At a minimum, you can take the list, go to your tax preparer, or you on TurboTax or whatever you use, and making sure those are the things you already checked it out and you know that you've gone through the list. All right, let's get going. Last minute 2024 tax saving tips. This is talking about 2024 tax filing, and we are in 2025. So before we go into the actual content, just want to let you know that this is our firm's website, communitycpa.com. This is our firm's YouTube channel, and you actually logged in right now. You're listening to me is because you actually come into the live session. I am talking, you're there, so we're at the same time right now, giving and receiving. And this is our channel, and you can subscribe when you do, and you will be getting notification from us. So that way, you know what we are talking about for at any given time. We do have another webinar in Spanish, then another in Chinese. So Tuesday, English, Wednesday, Spanish, Wednesday, Chinese, Thursday, Spanish, Saturday, English again. So this kind of how we serve the population right now. And this is some data about our firm. We have 5 branches. Houston, Texas is our newest one, and I am in Houston, Texas. And here it is our 2 books that I wrote in 2019 and 2023. So I'm doing the 3rd one. And this is a announcement to say the knowledge we provided here free of charge. So make sure when you use them, you use it carefully and making sure you get some professional help to utilize all these ideas, right? Number 1, so we talk about things that we can deduct right now for 2024. Accelerate business expenses. This is just how very generally people will say that, okay, can I reduce my taxes for 2024? And you're sitting right in front of the tax preparer and you're like, can we do some deduction? Can we accelerate business expenses here? Then your tax preparer might go, what do you mean? If that is the case, and you as a business owner, and you should know. You know how when you are running business, you either use cash method or accounting. In terms of accounting method, is cash method or accrual method. If you are a business owner and you do accrual accounting, right now you are in the month of March, and of course 2024's book is already done, but do you know that you can look at your expenses from January to now, see whether any of those should be payables for December. The reason I say that is once they are payables for December, you got more expenses, right? This is one way to look at that, and what you are paying right now, they may belongs to last year's. For example, right now you are paying some subscriptions, but it's for December, then you should be moving that into December because you are accrual method accounting. Check to see whether any balance sheet asset should be written off. What I mean by that is give you a story. And this is related to the investment impairment testing that you could do and write off your investment. So Elon Musk back in 2021 and did impairment testing on his investment on Bitcoin. And he wrote off millions because of Bitcoin dropped in value. So he gave the investment a new value. Let's say on the balance sheet you have $5 million on the investment, but now worth 1 million. You can take the 4 million into your income statement and deduct that as your expense. This is what we call the balance sheet asset readjusting and re-examining and evaluating it. Of course, you don't want to do valuation just because you got a cup of coffee and you're a little woozy and you just do the evaluation. You got to do it with a third party involvement. Let the third party service provider give you that value. Maybe that is your investment statement from Ameritrade, and maybe that is another CPA firm provided this to your invested project and saying that the project worth zero, but you got 500,000 on it, then you can write off your 500,000. So these are the things. Check to see if any balance sheet asset should be written off for year 2024. This is another way to accelerate your expenses, right? Inventory valuation. You got your inventory going on, but do you really think that's your inventory for the end of the year? Maybe you should be doing your physical count and replace the value you have on the balance sheet and give a new number. So remember this, the higher the inventory you have on the balance sheet, the more taxes you pay. So if you want your taxes to go down, you want your inventory to be as lean as possible. So that way most of the inventory are into cost of goods sold, so you can deduct that income, right? And also accelerating your business expense related to PTOs. If you have employees and they are accumulating their vacations, they didn't take it, but they're going to take it next year because you allow them to do that. Do you know that those PTO amount is really earned in 2024? So you can deduct that. You need to estimate what that value is and then deduct that. So when they take it, and they take it in 2026, 2025, but you deduct it in 2024. And what about your bonus? If you know that you're going to give bonus to your employee based on 2024 performance, that should be accrued. So make sure that you accrue that expenses as well. Then the investment, I sort of already gave you an example. I was giving you an investment example, but could be your machine, right? We have a dermatologist client bought a laser surgery, laser kind of skin related, I don't know the name, it's just laser machine, and spent $120,000. The machine came in, really never worked. It's so hard to manage. So our client was spending time, supporting service money, trying to get it work, and it didn't work. So at the end, a year later, and this dermatologist, they're making a lot of money, and 120,000 maybe it doesn't matter, but they wrote it off, and because this doesn't work. But if you are not doing that examination, you probably leave that machine on the balance sheet doing 15 years depreciation, what have you, that would not work, right? So you want to evaluate things very aggressively, properly. When I say aggressively is leave no stone unturned. When I say properly, you got to have a business reason and business business purpose to do what you do. So that would be the key. Number one, very important. This is where I'm saying that this is your last minute tax reduction actions you can take, and no brainer. If you don't, then you're missing out. What about review income? You got income, right? You may say that there's nothing to review. Income is income, Ying. What are you talking about? Of course, income is not always income. Some of the income you're getting, it is your unearned revenue. It is your liability. For example, on December 31st, and you got a big client gonna build a home with you. You ask them to put in $250,000 deposit, and so you can start working beginning in 2025. $250,000 deposit. You haven't even spent any 2x4s yet. You didn't even do any lumber work. You didn't do anything, but you got 250,000. Do you want to put that in as your income? No, right? You don't want to, because that is unearned. That is customer prepaying you. It is not your income. If the customer changes their mind, you have to pay it back. So it is your liability, right? So make sure. And then the other good example would be, education. We have a gentleman who operates a non-credited education program, teaches people to do online stock trading, stock market, day trader kind of thing. So he operates his classes 9 months. 9 months is one set of class. So he offered twice. One time is in the summer, one time is in December. So 6 months time, and he does 9 months. So he always, at December year end, he always have quite a bit of classes that he already got the full fee, but he did not teach yet, right? This is where you need to structure that out, figure out which part you didn't earn yet. Don't let yourself pay taxes on those because you did not earn. But of course, next year when you file taxes, you need to count the one that you did not pay taxes yet. Don't miss out those ones. But the unearned is very clear, right? It's existed in many businesses. And review your account receivable ledger. Anything that is over 120 days, they're not your income. They're actually just not anything. They need to be wiped out, written off. They're not your income. So don't try to think that everything in your account receivable is your income. No, not everything. I mean, depends on what industry you're in. The allowance for account receivable is for that purposes. So people, for banks, I used to work at Wells Fargo, and we do these allowance for account receivable every month. And that deduction is so crucial for the shareholders, because the more I bring in to the income statement to deduct, which means the more allowance I do, then less profit they get, less dividend the shareholder would get, right? So that receivable is literally reducing your taxable income, the allowance. The allowance to receivable reduces your taxable income, therefore reduce your taxes. And go with what IRS has under your ID. The reason I say that, nowadays technology is so mature, right? So IRS knows every move we make. So you trade, you buy, and IRS has the documents, and they got 1099K. The merchant account transaction is even uploaded to IRS, so they know that. And you need to know what IRS knows. So this is another thing, and we will say that to get your taxes done, very well done, and done in such a way that you have a very low audit risk, you need to do data match. And our firm, we provide a data match service, and you can also do that on your own. You don't have to get anybody to help you. You can call IRS, you can go onto their online and downloading all of your documents from IRS and see what they have for you. So let's say you say, I made $5 million sales this year, but IRS has 1099K. Added up together to be about 1.3 million. So you say that, well, I reported 5 million, IRS only have 1.3. I'm so golden, I don't need to do anything. I can just put $5 million on there. There we go. No, you need to put 1.3 first to match to IRS. Then you take the other 3.7 into other payment method to come up with total of 5. Otherwise, the IRS will say, oh, you got 5 million. You forgot that 1.3. We did not see that on your tax return. Then what? You're just going to go back to tell them, sorry, IRS, I put it together. A good answer. But what? You're going to wait for months, years and years with all these layoffs going on with the government. Nobody going to work in the government. You know what? If you are charged with taxes to pay, interest penalty going to continue to run because they are done by machine. They're not done by human. So the machine will continue to give you more charges. Even if you pay, they may not have time to even, offset your debt. It's just going to be a mess. So the best way is to do it clean, do it from the beginning, and check your POS system. If you are running a retail, you have a POS system, you think your POS system is not connected to IRS, you're wrong. If your POS system provider get investigated by IRS or get audited by other government agencies, they can audit you too. So make sure your POS system data matches to what you're doing with the IRS. All right, then what else? The other big trick is start a nonprofit and donate, right? So donation is always a thing. Well, we donate, we don't pay taxes. Congratulations, that's true. But donating to your own nonprofit, the reason I say that is story. I'll tell you a story. Some time ago, don't remember when, I have a client, and they are actually always they produce this sheetrocks, manufacturing, small scale manufacturing, produce the sheetrocks, and they take the sheetrocks and they put protective film on it, then resell it. Okay, but for the longest time, they actually would just get those sheetrocks to the homeless shelters and donating to homeless shelters. Then the homeless shelter will use it for their renovation, whatever they do. So they have been doing that a lot in one of the years. So, but then by the time they wanted to get a receipt or something from the homeless shelter, it was actually closed. So they couldn't really get any proof other than they know what they did, right? So what happened is because they are doing that all the time, so we encourage them to set up their own nonprofit organization. Because of all these materials they donated, they could donate to their own or a nonprofit. Then that nonprofit can actually give it away or build whatever they need to do, right? So with that, they can account on those donations that they already donated, and they don't really have any ways to figure out how to get the receipt that to show those are proper donations. So with that, and they form their nonprofit, as long as when you form the nonprofit, you have the operating date to state properly into the beginning of the time. Let's say you started in January the 1st, 2024, then you just put your nonprofit activity started at that time. You can always take your time to apply for the non-taxable exemption status. That is not something you have to do it right away. You can take your time to do it. Even if you do it right away, IRS is going to take 6 months time to approve it. But as long as you already put the application in with IRS, then you actually safe. You can already act, perform, and do accounting as if you are a nonprofit organization. So imagine that if you spend money, if you paid your personal funds for certain good cause, and you were never really going to count that as deduction because you were giving it to somebody who is handicapped but didn't really go through a nonprofit to do that, you can't deduct that, right? But if you go through a nonprofit to do that, that nonprofit give that to the handicapped person, then you can do it. So think through that process. It is not late. You can still start a nonprofit and retract your donation. Retract your donation and deduct that properly. And put in retirement funds is another one. And then, go without saying, everybody doing that, right? They go before April 17 comes about, they rush into the bank. And on the 16th and on the 15th, which is Saturday, and rush to the bank, buy traditional IRA. Oops, get some deductions out of there. So people do that. But what we are talking about here is for a business owner, when you have retirement account, company can contribute as well. The company contribution doesn't need to happen in 2024. You can deduct in 2024, but company contribution happens in 2025. So you may say, well, how much? So let's say if your salary is $100,000 out of your own business, and if you want to do company contribution, say you are the only employee, you paid yourself $100,000 and you have a SEP IRA plan, then you do 25% of 100,000, 25,000 you can put in your SEP IRA plan today on March 4th, and so put it in. But just when you do that, you want to work with your financial planner to earmark that for 2024 contribution. So when you do your 2024 tax return, business tax return, you will subtract 25,000 out of your total sales. So your taxable income reduced by what? By $25,000, right? And 25,000, if your tax rate it is almost 30%, then don't you save about $7,000? That's what that is, right? Same thing with solo 401k. You save 25% of your salary, and that's company contribution. If you have cash balance plan, do you? You should. That cash balance plan, let's say the same example, you were paying yourself $100,000 on salary, and you are the only employee, you made your 401k contribution. Come to cash balance plan, you probably can make between $100,000 to $200,000 again onto your pension plan. That you can do it in 2025, deduct that in 2024, and it reduces your taxable income. See? So these retirement money, it is one of the most effective way to reduce taxes, especially when you have the cash flow. And we always say, in our firm, we call the retirement money the purple money. And we call the money that you already paid taxes, you are free to spend, those are green money. Those are just the bills that we see, they're green, right? And when you take your funds, your made money into purple, and they don't pay taxes, they are free from income tax, both federal and state. So that is an effective way. And imagine you put away $169,000 a year of your income, and you put into retirement. That is a huge saving year after year if you just practice this way, right? Of course, you can always make traditional IRA contribution, and for 2024 individually, you can just go ahead to anywhere, your financial planner or the bank, buy your money and spend your money, and get about $1,200 deductions, savings out of your tax, okay? So my next slide is about Roth IRA. I personally do not believe in Roth IRA. I'll tell you why. Of course, when I say that, a lot of financial planner would be like, oh, Ying, you don't know what you're talking about. Let me just say why I say that. So Roth IRA is based on you paying more income tax when you retire, when you are older. So how many people did I see paying more taxes when they retire? And I have over 12,000 clients, and I have a very good database, and I do analysis on my database, and I'll tell you that there is no one paying more taxes when they retire, left their job and into retirement mode, and they pay more taxes. No one, for two reasons. Number one, they generally make less. Number two, the government policies right now, the baby boomers are the huge cluster of people and these people are still in charge, right? They're still the president. They're still the power to be, right? So those people will not tax themselves more. They will reduce taxes. You see at the state level, income tax are reducing. And you also gonna see, you already see all of these efforts saying about not to tax on seniors, not to tax on Social Security. There's so many things going on, and to the efforts of reducing taxes to the future, you don't want to predict 20 years ahead of you. In tax world, we are short visioned. We only care about this year and next year. The most I care about the duration of the White House residence. Just depends on how long they live there, right? So really, taxes is short vision. You don't want to project for 20 years. If you can save $1 today, don't listen to someone tell you you're going to save $100 20 years later. The person who said that may not be there 20 years later. You can't keep them accountable. And what they say, they can say whatever they want. So for that reason, I also encourage my folks to actually sign up with financial planners who are young and who are new to the field, just not because they don't have experience, we like to, tell them what to do. No, we want the person to last longer than we are, because that is when you needed help. You can't be, doing financial planning with someone 10 years older than you. So what you're saying, so they die and you don't die, and then your things is in a mess and you don't even know who to talk to, right? So don't put money, don't put contribution, your cash flow into Roth IRA is not a mean to save taxes. No, future taxes is a bow. It start with a bow. I don't want to say that bad word, but it is not something we care. Dig your disallowed losses. This is another important one. It is the one that's going to benefit you right now, and you want to find out how much of a money was disallowed from the past. You may say that, Ying, I don't know where to find it. It's on your tax form. It's on your tax form, and if you just flip every pages, and you will see the losses. Schedule D has, Schedule E has, so they all have disallowed losses if you had them, and they also give you a total. Sometimes the tax software will give you a summary of that amount as well. You want to find out what they are, why they are, then you do something different in 2024 to treat it in 2024. So example I would give you would be that we have a client, couples are in business together, but the ladies never really get involved with the business, never went to the business, but the gentleman is the one running the business every day. But the K1 came out, charges the ladies is never really in the business, so he's passive investor. So whatever she has, it is a passive losses or passive gain. So that's subject to disallowed if their income is too high and she cannot write them off. But if it is active involvement, then it will be deductible. So then our recommendation would probably end up be that you need to work there. You need to get a little small pay or a little guaranteed payment, and so you work in the business so we can turn your K1 from passive to active. So those are little things that you can do and consider and fix. Even if you don't fix in 2024, at least do that in 2025, right? Consider, this is what people call that tax loss harvesting. So you want to plan. You want to plan your things around. Do your 2024 tax return in such a way that you're going to use your losses, okay? So that is another one. It is pretty deep subject, and I know I touched on it, but all I need you to know is to have that buzzword to say that, well, to your tax preparer, do I have a disallowed losses? Yes, you do. Can we try to use it up this year? I will think about it. Your prepare will do. They will think about it. They will help you. All right? Now, the other one is also a deep one, but let's just kind of simplify it, right? Say you run a really good business and every year you got such a big K1, you pay so much taxes. Whoops, just like every time the tax time is you giving out cash present to IRS. And you didn't want to do that. Then what you can do is to consider whether you should start passing your business to your children. So through what? Through gift taxes. So remember, gift tax every year has this limitation, like 18,000, 19,000 from you to your son, but another 19,000 from your spouse to your son. So he would end up with $38,000 every year. That's free. So you take the $38,000 and you will evaluate your business shares to see how many shares equals to 38,000. Maybe that is 38 shares. Then you will be transferring 38 shares to your son, and your son would get a little K1, and so he will share your income. So he'll pay it on the lower tax bracket, and you get less, but year after year, he got more, you got less. By the time you die, and he already have all the business. This is a step that takes time to do, but you can start right now for 2024. So if you ever thought about it, I want you to come to our shop, and we have done that for many clients who are very comfortable and very knowledgeable in terms of how to move that ahead for you, so you can end up dying without getting into estate tax. You don't know when you die. If you die right now, you got $13.99 million estate tax exemption. Good for you. But what if you die and the president says it's $3 million? Those numbers are actually goes by the residents of the White House. It's not so much of you, me, and others to decide. It is literally what they want to do. It's a man-made threshold. Sometimes I wonder, why don't they just make a nice number like 18,000, like 8,000, with 8, would that be nice? Because we, Asian populations, right, we like 8. 8 means fat, right? So why not? They make it 13.99 million. Do you think they're crazy? They're more than crazy, actually. All right, so my next slide, it is the tax credit for business. Then I have another one, tax credit for individual. The tax credit for business, I just really want you to, I invented the other two by mistake. It's actually 10 of them. So you just look at these ones. They are the credit you need to know. If you are like, oh, I filed a business tax return, but I never really heard of these credit. You know what? Then that means you are an adult, but in elementary school. That's just best way to describe your tax existence. So don't do that to yourself, and you need to know all of these 10. So I'll quickly go through that. Work opportunity tax credit. If you hire veterans, if you hire single mother with food stamp, you qualify for that. If you hire a summer student, you qualify for that, okay? Then you have this investment tax credit. This is also something that if you spend on it, and you can have $10,000 annually coming back to you as a tax credit. Tax credit and a tax deduction is not the same, right? To reduce your income by $10,000, that's small. But to give you $10,000 tax credit, that's big. That is about $200,000 income tax deduction. All right. Employer credit for paid family medical leave, that is still available. Still available. Do you know that you have your people and they're sick and couldn't come to work, and the parent die and they need to take a leave, the qualified leave, and those are 12.5 to 25% of wages paid to the qualified leave. Those are available, still available up to 2025 this year. Small business house tax credit, if you have fewer employees and a 50% there's a bunch of premium that you paid will come back to you, okay? And the research and development tax credit, this R&D credit, is not good yet as we speak right now, but wait until later this year. Hopefully it will revert back to before 2022. And we are getting ready to do a lot of claims for quite a bit of our clients. And your fuel tax credit, if you drive a lot of construction vehicles and with diesel fuels related to activities, and electronic vehicle tax credit, just like those Tesla cars, personal side has that, business has too. If energy efficiency home credit, if you are a builder, and you get that, and advanced energy project credit, that is manufacturing, investing in the energy project, then you would get some tax dollars coming back to you. So with that said, those are credits out there. The name is there, so you can research more, or you can give those names to your tax preparer. Let them figure out you don't qualify for any one of them. For the personal ones, that is about 11 of them: earned income tax credit, child tax credit, dependent care credit, and the tuition credit, American Opportunity Tax Credit, and the lifetime learning credit. There are tuition ones. A premium tax credit, if you pay too much on medical insurance, you get some money back. And retirement savers credit, that is the one that give you up to 10,000 contribution reduction if you qualify for that savers credit. You have to be at a certain income level. Adoption credit, if you adopt a child, not a dog. The dog don't qualify for that. I really wish that they could do that. Then I would probably see more fur babies getting adopted. And the residential clean energy credit, those are another one. And electronic vehicle credit for individual, and the saver credit, that's a 10 to 50% of your retirement contribution, is actually the up on top. So it's 10 of them total. All right, so take a screenshot on this one. Make sure you check out every one of them on your 1040, right? Okay. So with that said, I would go to just to remind you, oh, that's my Peanut. So Peanut, come over. Yeah, come over, Peanut. Okay, that's my Peanut. So that's income tax due on March 17th. No, you don't. You look at my slides so you don't make sound. So the income tax for companies is due on March 17th. The income tax for personal is due on April 15th. This is this year's schedule, right? So just be sure you know that. So I want to say that all of these lists that we're going through is actually something we do when we plan your 2024 taxes. So we have already done that for a lot of our clients, but for you, since you are not our client yet, or maybe you are our client but you didn't do tax planning, this is your last minute rescue. Make sure that you do that to get yourself into a tax efficiency mood, right? So, but for 2025, you want to consider to do a planning. If you do the planning for the list I gave you, that's a good reason. But for 2025, one more good reason is the changes that in our federal government, the regulators, the President Trump, all of these changes are coming in, and they can provide you with opportunities, can also provide you with drawbacks. So it will be your play to make sure that you stay at the better side of it, right, for whatever comes up. So you also can see, you can go to our website to check our partners, make appointment with us. And in here, I also have an email address, Catherine@communitycpa.com. She actually is the one that gathering all the talking point, and you can talk to Catherine, email her, so she will actually bring your idea to our plan, and so we can plan the topic for you. We do try to answer the questions come to us, so to make our webinars more relevant, right? All right, that is all for today, and I apologize for Peanut interruption, but he's always a very good dog. He's a people dog because when he see people, he never barks. But when he see dogs, he barks. I always trying to figure out whether it's because he's too excited to see another dog, or if because he's too mad because he's not elite. He's not the only one. If you have the answer for me, let me know. I really don't understand why Peanut is so mad at looking at other dog. Sound mad, but maybe it is not, right? Because I don't know how woofs goes in terms of feelings expression. And I'll talk to you again, and now you get to know my Peanut. And he's with me every day. Bye-bye.